Hi class, welcome back to EdVantage. I'm Matt Fisher, your accounting professor, and in today's video, we're gonna go over sales discounts, sales returns, and sales allowances. In the previous video, we already went over this from the buyer's perspective. In this video, we're gonna go over it from the seller's perspective. So let's assume that on October 1st, we sold $150. We sold for $150 inventory that cost us $100. So the sale was for $150. So let me write here. On the 1st, we had a credit sale of $150. And so then we're going to credit sales revenue. I just put sales there, but sales revenue, $150. When we're selling inventory, that's one of those double journal entries. So the other part of this journal entry would be to debit cost of goods sold and credit inventory. And the cost of that item was $100. So you can see here our revenue of $150 less our expense, cost of goods sold, $100 gives us a profit of $50 with regards to this. The credit terms, I'm going to write them up here, were 210 net 30. So hopefully you remember from our previous video, that means that the buyer will get a 2% discount if they pay within 10 days. But the whole thing's due in 30 days. Let's say that they pay us on the 11th. So within 10 days, they're now paying us. So we're gonna get cash. So now we're gonna debit cash. Now we're not gonna get the whole $150. 2% means we have to reduce that by 2%. 2% of 150 is $3. So we're gonna get cash of 147. We're gonna credit something 3. We'll come back to that in a second. But now we need to get rid of this accounts receivable because this shows that this customer owes us $150, but the customer is now paying us. So we have to eliminate that. So that's a debit, so we have to credit accounts receivable 150. So you can see here, right now, our journal entry has an account for 147 and 150. What is this $3? Well, this is a new account. This account is called sales discount. Sales discount is a contra revenue account. So I'm going to put right here, contra revenue. A contra revenue account. So what happens here is, look what it shows our sales at. It shows sales, so if we were gonna look at our income statement, it shows sales revenue of $150, but this contra revenue goes with this. So I'm gonna abbreviate here, less sales discount of $3. So you can see our net sales then is $147. Okay, these two accounts go together, sales and sales discount. Oh, and I did kind of make a mistake there. That shouldn't be indented. Okay, so it should be sales discount $3 there, right? So the debit was right there. I just shouldn't have indented that because that's the debit. All right, so anyway, this is still a contra revenue account. All right, so hopefully this makes sense to you. Now let's take a look at what a sales return would look like. So I'm going to erase this. Let's use similar. We'll change these numbers slightly. Let's say that we had a sale on October 1st for $300, and the items that we're selling had a value of $200. So then we'll debit cost of goods sold and credit inventory, $200. Now, the customer decides that they don't want these items anymore. So they're returning them. So for a return, and I'll just make up a date here. Let's say the return takes place on October 6th. The return, for the most part, just reverses out these journal entries, except for one exception. We're not going to debit sales. Instead, we're going to debit an account called sales returns. I'm going to abbreviate here, and allowances. Sales returns and allowances. That's a new account. So this includes both the returns and the allowances. This is a return, so we're going to debit at 300, and then the rest we're just going to reverse out and credit accounts receivable. So we're reversing this out, but instead of sales, we're going to use an account called sales returns and allowances, and now reverse out the accounts receivable, and now these two need to be reversed out. So we debited cost of goods sold and credited inventory, so then we're going to debit inventory and credit cost of goods sold because they're returning it, so it's going back into inventory and we're reversing out the cost of goods sold. This account is a contra revenue account. Sales returns and allowances is a contra revenue account. And so if we were to look at an income statement view that goes along with this, you'd have sales less sales returns and allowances. And in this case, the sales return and allowance was 300, so it zeroes out. The reason why we're doing this and not reversing this out directly is because we really did have a sale. So we want people that are looking at our financial statements to know we had a sale, but then we also had a return. So that when they're looking at financial statements, they can see the dollar amount of our returns. Okay, now let's do another example. This was a return. Let's take a look at an allowance. An allowance means that this customer wanted to return, possibly wanted to return some of these items that they purchased. But instead, the seller agreed to a reduction in price, and the buyer agreed to that. So let's say that the seller agreed to reduce the sales price basically by $40. Well, this journal entry will look kind of similar to the last one in that we'll do sales returns, but this isn't a return, but remember it's returns and allowances. So we're going to debit sales returns and allowances for that reduction, $40, and then we're going to credit the accounts receivable, $40. So if we were to look at our accounts receivable, it originally was 300, and now we're reducing this by $40. So this customer only owes $260 now because there was a reduction in the sales price. There was an allowance given. Right? So this is how we would do a sales return and allowance of $40. Remember, the sales returns and allowances, that account is a contra revenue account. All right, class, this has been a lot of information. Make sure that you understand this, the sales discounts, that you understand what a sales return is and what a sales allowance is and how the journal entry is done. Let me point one thing out here. When we did this, remember, we did not reverse this out. Why is that? Because we didn't get back the inventory. The seller did not get back the inventory. All they did was reduce the price. So when it's an allowance, you don't have to do anything with this part of the journal entry because the inventory is not coming back. When it's a return, then this needs to be reversed out for the dollar amount of the return. All right, I hope this has helped. Make sure you go through this stuff several times that you understand exactly what a discount is, a return and allowance is. We hope to see you back in future videos. Good luck, class.